Welcome to It's the Economy. It's the new governor's maiden monetary policy and it is baptism by fire for him. The rupee is the worst performing currency this year, having fallen 2.2% since January, as you can see on the chart. Indeed, 1.2% of that fall has just come in the first 6 days of February. Does that give the governor much elbow room to cut rates and the cash reserve ratio, as people have been demanding? I have with me a veteran India watcher and economist par excellence, Chetan Ahya, Chief Asia Economist and Emerging Markets at Morgan Stanley. Chetan, good morning. Thank you very much indeed for joining me. And that is the first question. People want a CRR cut, they want a rate cut, and they want, push back on those LCR rules, benign credit deposit ratio statements. Can the governor really go all that easy when the rupee is falling so much?
Well, Latha, I think you are looking at year-to-date INR movement, but ideally what you should do is to look at it over a 12-month period. And especially since September of 2024, what we've seen is that the broad-based dollar has appreciated. We've seen a lot of other currencies in the region also depreciate a lot more relative to INR. And so we think that the INR had actually moved into overvalued territory if you look at the real effective exchange rate basis. And what the central bank is now doing is to let this adjustment take place, let the currency depreciate a bit, but ensure that in the meantime, they inject liquidity in the domestic economy to ensure that growth gets that support. So from an outlook perspective, we think that the central bank still should be able to cut interest rates and inject liquidity. And if need be, let the currency adjust and take some steam off. Of course, it's not going to be possible to keep the currency stable if you're going to ease monetary policy. But we don't think that the depreciation is too much in INR, that should worry the central bank.
Yeah, I take your point that depreciation, if you look at it from October, is not... in fact, we have the October table calculation as well. October to December, I think the INR depreciated by about 2% only. But then from Jan to October, it had depreciated by only 1%. Let me give you the other calculation. In November, when the REER table was given to us, the rupee was overvalued by 8%. But since then, India's inflation has fallen as well. There has been a decent depreciation from 84.1 or thereabouts to 87.5 as we speak. So how much more do you think we are in danger of depreciating? What's the MS view?
I think it's a function of the dollar and what happens to tariffs on China and some of the other emerging markets will matter, because that immediately has an impact on dollar and therefore INR. And you mentioned the overvaluation number for INR. We wouldn't just look at the 10-year mean as the fair value. We think that the RBI will be comfortable as long as it gets between 10-year mean and one standard deviation above that. And if we see some more depreciation in INR, which is higher relative to its trade partners, you can very soon get the INR into that below one standard deviation plus mean range. And so, yeah, I think rupee will be a function of what happens to dollar and then in turn what happens to tariffs.
Okay, fine. Then what's your expectation from the Reserve Bank governor in the policy?
So we are expecting the central bank to be easing monetary policy in three areas. Number one is we've seen them already beginning to relax the regulatory tightening which they had done on the non-bank financial companies. Number two, inject liquidity. That's also happening. And the third part is cutting interest rates. That comes on February 7th. So we think from a dynamic where monetary policy was relatively tight, not just necessarily from interest rate perspective, but from liquidity and regulatory perspective. Right now, we are looking at all the three areas of monetary policy support coming in through from February 7th.
Oh, that is the ask of the market. Liquidity, regulatory and rates. Let's see whether they go the whole hog just because the rupee is creating some panic. Chetan, what's your sense about the tariff war itself? I know it's an unfair question because we don't know how talks will proceed, but are you expecting an all-out tariff competition with China being just the start and, India at some point in time coming into the reckoning? What's the view on Asian growth as of 2025?
So the way we are parsing this tariff story is sort of trying to think whether there is going to be targeted approach of lifting in tariffs on China imports by the US, or they're also going to take up broad-based tariff increase on multiple trade partners eventually almost at the same time. This is a very important difference in terms of the actual actions, because my experience from 2018-19 tells me that what happened during 2018-19 is that the direct effect of tariffs on China were not that big in terms of contribution or drag to growth. But the corporate confidence globally got affected. Global capex came down, and that affected Asia's exports, including India and China. So what we are now thinking is that if there is a targeted approach of just focusing on trade tensions with China, maybe the corporate confidence will not get that big a hit. But if we do see eventually multiple trade partners getting into this dispute, that will have much bigger negative effect on trade and therefore region's growth outlook. And so if it does turn out to be multiple trade partners, we are right now putting in a number of 1 percentage point loss of growth to region's GDP. China should also see 1 percentage point loss. India will see less to the extent of 30 to 50 basis points. But that's the kind of number that we're thinking if there is a broad-based rise in trade tensions.
Then, so where it's 0.5% from what? As in, what is your anticipation of current year's growth itself, FY25, and what's the FY26 expectation, GDP?
Yeah, so we are expecting growth to accelerate to 6.5 on a quarterly basis from March 2025 quarter. Yeah. So effectively see 30 to 50 basis point hit from that starting point.
Oh, so if the tariff escalates, then that 6.5 may not be delivered, is what you're saying.
That's right. But broad-based tariff increase rather than just targeted on China.
Fair point. Okay, if it reaches our shores. Therefore, you think the Reserve Bank has enough space to cut? What are your inflation expectations, and therefore how many rate cuts?
So currently we are building in 2 rate cuts, and that's under the assumption that growth does accelerate to 6.5%. But if you don't see that growth accelerating to 6.5% because of tariffs or other reasons, then we see the risk of central bank cutting additionally in line with declining growth rates.
Okay. Is there not an expectation of fairly serious disinflation in Asia because China is not allowed to import as much to the United States? Do you see that pressuring Indian inflation also down and therefore more than 2 rate cuts?
Yeah, it's not necessarily that China will ship the stuff out to the rest of the region or world, but to the extent to which, you do end up seeing a dynamic where there is broad-based tension slowing down global growth, global trade, what then happens is, and if I just recall my experience of 2018-19, is that there was a big challenge in terms of global goods demand supply balance. And that itself causes decline in prices globally, not just in a particular region. So yeah, I think tariffs are disinflationary. It may just mean temporary rise in inflation on the countries which are, in the case of countries which are imposing tariff, but eventually this is deflationary to the extent to which it does affect global growth as well.
Okay. Yes, so maybe inflation initially and deflation later. So what will be the Fed rate cutting trajectory?
So currently what we are assuming is that tariffs are not going to go up in a broad-based manner, but even to the extent to which there has been a talk of tariff increase on some of the trade partners, our US economics team has taken out one rate cut out of the two that they were forecasting. So we are only expecting now a 125 bips rate cuts this year.
Okay. Now to come to the budget, do you believe that this consumption story will fire up? And in spite of it, you have only a 6.5% growth?
Sorry, I didn't get the second part of your question.
Sorry, the budget is expected to fire up the consumption pace in India. It's giving away 1 trillion rupees by way of taxes. Will that, in spite of it, you expect only 6.5%?
Yeah, that's right. I think there is a challenge in the sense that the government, as you know, in the budget has decided to push consumption, but at the same time, capital expenditure growth has been relatively less than what it used to be in the past. So considering both the aspects taken together, we think it will be still 6.5% GDP growth. We do expect consumption to get supported with the actions which have been taken. And we also think that the monetary policy support will come through. And the fact that, there is some increase in capital expenditure that is going to come through as well. So a combination of some increase from the government side on capital expenditure, consumption support, and monetary policy easing. And I would also like to highlight one other point, Latha. When I'm thinking about growth outlook, there is a decent pickup in services exports, and services exports have now built up to about close to $390 billion annualized. So that's a pretty big number, and that's growing at about 15% on a 3-month moving average basis. We are kind of building in a support from that as well to discretionary consumption and job growth.
Okay. Oh, that's good. Good to hear that. Anything by way of job growth. Chetan Ahya, always a pleasure having you with us. Thank you very much for joining us. So that's a clarion call for a many-sided move from the Reserve Bank. Morgan Stanley, Chetan Ahya are expecting a rate cut. They're expecting liquidity to be eased, as well as some regulatory easing as well. Well, risk weights have been raised on loans given by a bank to an NBFC. Will that be lowered? We will have to see. If that is done, then tomorrow we can see a decent rally in NBFC stocks. Well, a rate cut will immediately be not terribly positive for banks because they suffer from margin drop when rates are cut, at least in the first few months. So we'll have to wait and see. Banks and NBFCs will be on top watch. But before we wind up, let's wind up with something on tariffs. Tariffs is still the biggest talking point among economists and investors in the US. And on that note, let's listen in to what some experts have to say on the impact that tariffs may have. After that, it'll be time for a break and then Chartbusters.
In terms of what have been the results over the last 8 years of these policies is something worth evaluating, and then also seeing about what else can be done to help increase US share in global manufacturing if that's the ultimate aim. One thing which clearly doesn't help is a stronger dollar. So under that environment, the US is very uncompetitive, and that doesn't help its cause. And every time there is news of tariffs, the dollar only tends to appreciate, which is counterproductive and something that's happened over the last 8 years. So that's a very important policy tool the US also needs to keep into account.
Watching laws being made is kind of like watching sausage being made. You really don't want to see it. And maybe that's the same thing with tariffs. It's too visible here. And there's a lot of negotiating going on. And we start out on Monday with the market being freaked out. And by late in the afternoon, Mexico gives Trump something, and he says, "Okay, we'll postpone things." So it's a negotiating game, and I'm not sure it's really all about tariffs per se. It's not just a tariff war. It's a war over national security, a war over drugs. There are a lot of issues involved here, and the market's saying, "Well, what does this really have to do with us?"